Hello, everyone, and welcome to my YouTube channel. I have the distinct pleasure of having with me today Chance Finucane. He is CIO of Oxbow Advisors. And he is also somebody that has quite a unique view about different elements of how to basically invest right now in an environment in which there's a lot of exuberance and tremendous optimism. The reflation trade is one of the things that everybody's talking about. And within the reflation trade, many people play it how with banks. No, banks tend to benefit from rising inflation because rates are expected to go up, because inflation is also maybe coming from a higher level of growth, and all of that with banks being a multi-levered bet on a recovery, it generates this long position on financials. However, Chance has a different view, and he believes that now is the time to sell financials. How are you, Chance?
Doing well, Daniel. Thanks very much for having me.
Well, it's a great pleasure. Tell us a little bit about the thesis behind your view.
Sure. So we were just looking at over the last, say, even 7 months, basically since the announcement of the Pfizer vaccine in November, the largest U.S. bank stocks have appreciated by about 60% in value. And it's been a great, say, 6 to 12 month trade for anybody who's been able to participate in it. But when we're looking at where bank stocks are trading today, there's a few things that make us just think that the upside's not really there going forward compared to the potential downside. So just to point out a few things. First, I think the announcement or the change in tone from the Federal Reserve in recent weeks, where there's some concern about inflation being a little bit more than just transitory. I think that's starting to signal that they may begin to taper their quantitative easing a bit sooner than people may have initially thought, or even the Fed might have thought. And they also might start raising short-term interest rates within 12 to 18 months. And what we've seen in the last 3 to 4 months is a change in the way that different sectors are trading, where I think investors or the marketplace is starting to anticipate those rate hikes, which could then cause economic growth to slow a bit, and that some of these more reliable growth companies may outperform while banks slow down.
Mm-hmm.
And two other points on top of that is just the earnings per share growth for banks, which have rallied and grown substantially in the last year. They've benefited so much from very volatile trading environments that boosted their earnings per share. That's going to fall off as markets start to be more normal. The VIX has fallen back below 20, and you're actually going to see earnings per share decline for most banks. And the last piece is that the price to earnings ratios of these companies are about back to their average over the last 5 years. And usually when you get to about that point, you're really relying on earnings per share growth, which is going to be tough, I think, over the next intermediate term.
I would like to go in detail through each of those points, starting with the last one that you mentioned. There's probably a lot of optimism out there when I speak with investors, when I speak with investment banks about the confidence on beating earnings estimates, because the first quarter, to be fairly honest, has been quite positive in terms of beats relative to misses, and there is a tremendous level of optimism expressed in the earnings growth of banks. One of the things that you just mentioned is slowdown, or at least a moderation in the trading profits of these banks. And I wanted to get a little bit of your view of why, as it might sound counterintuitive, I understand it, but for our viewers, why would trading profits weaken once the recovery is fully fledged?
Sure. So banks' trading departments, and I have the benefit of knowing a few people who work in as fixed income traders, for example, at some of these large banks. They profit off of the extreme volatility that may happen at distinct points, like we had in the first half of last year. And trading departments were doubling the amount of revenue that they were putting up in a normal environment where there isn't that much volatility. So the spreads that they're going to earn as things are starting to return more to normal, where you're not seeing quite as much trading volume as you had last year, there's just not as much opportunity for them. So I think that's the first part for why you could see a bit of a pullback in their earnings per share growth. The other thing that I find interesting, a big reason why value investors own these banks, and we owned them in 2019 and then sold out of the big US banks in January and February of 2020, not because we saw the pandemic coming, but just that we thought we got to this same point we're at now. A big part of the value proposition is the capital return to shareholders, which you're seeing headlines about that recently, where the bank stocks are increasing their dividend per share now that they've passed the Fed stress tests, and they're going to start to buy back more stock. But as you know, in Europe, as well as here in the US, that capital return to shareholders only lasts as long as the government allows it. Once you go into a point where the economy gets a little bit choppy and governments begin to worry about economic growth and banks being able to hold up, they will restrict capital return by banks to shareholders. And that's what happened at the start of the pandemic last year. And the whole value proposition for owning the stocks went away. So that's something that I think makes you need to be able to be agile where you're trading in and out of bank stocks rather than holding them all the way through an economic cycle.
That's a very important point, because many people perceive the current regulatory and fiscal environment as beneficial for banks, but they tend to forget, and we have seen it very, very evidently in the Eurozone banks, that governments immediately step and curb the desires of management to increase total shareholder return in times in which the economy not slows down alone, but also in times in which the economy simply is stabilizing. And that's a key point you mentioned. On one side, banks benefit from increased volatility, not increased growth in itself. Second is that the capital returns tend to be diminished once the recovery is in full form, because that's precisely when non-performing loans rise. People have forgotten about non-performing loans. Is that non-performing loans never happen throughout the crisis. They start to come up once the recovery is in full form. And that goes to your point about the earnings per share. I wanted to ask you about the tone of the Federal Reserve. You mentioned how the Federal Reserve is talking about rate hikes in 2023, and that can generate a little bit of a headwind for banks. However, usually investors tend to believe that hiking rates is actually good for banks. Why would it be different this time?
I think what's different is that people think that higher interest rates are good for banks, but what you're really paying attention to is what they call the yield curve, which is the difference between short-term interest rates and long-term interest rates. So if you think about the pure operations of a bank, they're going to pay an interest rate to their depositors, any customers of their bank. You get a deposit rate for having some money in your checking account at that bank. And then they're going to take your deposits and make loans out to businesses or individuals purchasing homes at a higher long-term interest rate. And their profits come off of that net interest margin spread. And you need that gap. And what ends up happening is if the yield curve is flattening, where long-term interest rates are coming down while short-term interest rates are going up, that starts to crimp on the net interest profit margin for banks. And banks actually want a steepening yield curve, which is what we've had since the middle of last year. But we've started to see sort of a flattening or the yield curve kind of top out here. And every time that QE has been removed in the last 12 years by the Federal Reserve, and you just let the marketplace run on its own, the yield curve is flattened, long-term interest rates have come down. And if you have the Fed raising short-term interest rates, that's not an optimal environment for banks either, which is another reason why we wouldn't expect earnings per share growth to really accelerate.
In the current environment as well, the general perception is that, yes, the Federal Reserve is talking about maybe raising rates in 2023. However, all central banks seem to be extremely dovish about maintaining the asset purchase programs. So you mentioned that actually that could be one of the negative surprises for banks, that quantitative easing is diminished. What is your view there?
I think we wouldn't rush to make a prediction. I don't think we know for sure, but just looking at, and I think you've done a good job posting some amazing charts of inflation staying higher than expected, especially in foods and services that are spent on every day by individuals around the world. If you have those inflation numbers stay higher than expected, I don't think that the Federal Reserve and other central banks are going to be able to continue with this rate of quantitative easing indefinitely. They're going to have to taper sooner. And then the question will become of when is there going to be the first rate hike? And we're already starting to see that shift where you're seeing the change in the 2-year Treasury yield start to go up, which is implying that there might be a rate hike on the short end before the end of 2022. And once that narrative starts to build, I think that's where you start to see a change in terms of which types of sectors are going to outperform in the equity markets.
Yes, because basically what we see is that the expectations about both the recovery and monetary stimulus are so optimistic that even a mild change of tone, like what we saw from the Fed, can create an important reverse in the reflation trade. You mentioned before how growth stocks are coming back while value stocks are losing part of the performance that they have achieved in the last months, particularly since September. If investors decide to take profits in banks, where do you suggest that they put their money?
There are a few places we think that still have some stocks that are undervalued if you're looking at the right individual companies. So the first place, you mentioned growth. I think there are some high quality growth companies in the technology and e-commerce industries that I think are still valuable. So there's some in the US, some in China. So in the US, I think Amazon and Alphabet would be the two that we'd be most interested in at these prices. And then in China, Alibaba and Tencent are two others that we think are undervalued at the moment. Beyond that sector, I think there are some healthcare companies. So some of the pharmaceutical stocks like Johnson & Johnson, Novartis, or Merck still appear undervalued. And then some of the medical equipment companies like a Becton Dickinson. The last area for anybody who's really looking for yield, there are actually some preferred stocks, some straight preferred stocks, and also some convertible preferreds that pay anywhere from a 5 to 6% dividend on average that we think are a pretty safe place to be for income. So actually the banks we were talking about, we still like the banks' balance sheets and how solid those large US banks are. So while we're not attracted to the common stock, they do have some preferred stocks that are trading about 5% yields that we think are attractive. And then there are a few convertible preferred stocks, which are a preferred stock that pays a 5 or 6% dividend that will convert into a common stock in a couple of years. Becton Dickinson has one, and NextEra Energy is another that we think those would be good opportunities.
Does the idea of preferred stocks for many of our viewers is sometimes a little bit of a challenging issue, no? Because in the European markets, preferred shares have been historically, yes, they tend to give a good yield, but there have been numerous cases of challenging environments. But the key thing is that what you see is that the balance sheet of the banks is solid enough. Are you worried in any shape or form about a big increase in non-performing loans or weakening of the capital structure? What would it take, for that to happen?
I'm not worried about that here in the US. I think one thing that I think makes it a little bit easier for the US banks is that their loan growth is not that high. So yeah. I think usually when you see a real increase in non-performing loans, it's because they're not having the same sort of structure to making the right choices for who they're going to give loans out to. But as we've seen for the last 12 years, the Fed's trying to orchestrate quantitative easing through the banking system, and the banks just aren't loaning anymore. And so the importance on having the right leverage ratios and not getting too far ahead of yourself on loan growth, we would keep an eye on that, but we're not seeing those go to levels that would make us concerned. The only other thing we would pay attention to is if you really saw interest rates become very low in the US, similar to what you're seeing in Europe and Japan. I think that makes it difficult for banks to generate the profitability that they used to, as you're seeing with some of the European banks and some of the smaller Japanese banks. We haven't had that issue yet in the US though, so we'll monitor it, but we think they're in a little bit different situation.
You don't see the risk of negative rates in the United States at all, do you?
Not yet. I wouldn't have thought that could have happened in Europe 15 years ago, but it's just something that we'll have to continue to keep an eye on.
Yeah, no, I think that it's significantly different. I think that the United States, there is no need from the either political, fiscal, or monetary perspective to get into the trap of negative rates. And if anything, I would hope that the Federal Reserve learns the lesson of the Eurozone and Japan, that negative rates actually generate more harm than benefit. So I agree with you that is something that definitely does not pose a risk. And there are many investors that look at global stocks that continue to like US banks relative to Eurozone or Japan banks because of that. No, do you see is there any threat, even if it's a long-term threat, for banks of central bank digital currencies? Because obviously, if the central banks start to implement digital currencies that eliminate the transmission mechanism of monetary policy through the banking system, obviously that is going to be detrimental to banks. Do you see that happening anytime soon in the United States?
It's an interesting angle you take there. I haven't thought about it so much for the actual US banks, where we've been focused on the central bank digital currency, that idea that a central bank of a country could offer up digital currency that would just land in individuals' bank accounts and would stay in that digital form, and then any households would have to spend it from there. You wouldn't be able to cash out and have it in your hand. I think where we're paying the most attention to that, and where we would be most concerned as it regards to the chance of inflation increasing by a great deal, would be if a country starts issuing digital currency during a crisis that has an expiration date on it that says that you're going to put $1,000 in your account, but you have to spend it within 1 or 2 months, where they're trying to really increase the velocity of money in the system. That would be our concern, because I don't think we would trust the government to be very disciplined about that. So I think that's where we've been most focused. I'd be curious, what do you think about how it relates to the US banks if the US decided to issue a digital currency?
Oh, I think that if the US decided to do it, it would absolutely destroy the commercial banks, because you've mentioned it before. The thing that keeps inflationary pressures from being very aggressive or truly dangerous is the fact that monetary policy has a number of backstops in the credit mechanism. So it always depends on the demand for credit. So you can increase money supply all you want, but if businesses and citizens don't demand more credit, then you don't generate an inflationary spiral that becomes dangerous for the economy. So it's easier to control. Now, if you issue a digital currency and you wipe out the transmission mechanism of monetary policy out of the banking system, then the risk of increasing inflation dramatically and entering into an inflationary spiral, apart from the issues of risk of surveillance disguised as money, and obviously lack of ability to be to have your own finances separate from what the government knows, all of that is a risk. But I see it as a very, very long-term concern, not one to believe now. And probably a central bank digital currency would be, in the United States, would be the place in which the risk is the lowest, I would say. Yeah.
Yeah. The other thing I find interesting, you pointed out just the demand for credit has not been that high.
Yeah.
It's interesting to consider both in the US and in Europe, the startups, the new companies that are being developed over the last 5 or 10 years are not companies that are trying to go out and raise a lot of debt. There's so much dry powder in the venture capital and private equity markets. And these are also business models that once they get up and running, they can generate a lot of free cash flow themselves. You're thinking of some of these technology businesses or fintech businesses. I don't think that they're going to a JP Morgan or a Bank of America to take out a loan. They're going through other avenues. And I think that's helped at least keep inflation down, where you haven't seen that loan growth really accelerate.
Absolutely. You've mentioned velocity of money and the fact that high productivity sectors do not require the level of capital in order to undertake their investments that was required 20, 30 years ago for different types of businesses. And the fact that all of these startups are raising capital easily, that there's tremendous appetite from private equity, etc., that limits the amount of credit demand growth. That's why we have this monster reverse repos all the time from the Fed. No, but all of those factors, coming back to your point about banks, are very important because what you need from where we are now, and I come back to your very important first point, valuation, is that the valuation of banks is already discounting the growth, the recovery, the improvement in inflation, and the margin expansion. Is that all of that is more than discounted, but the headwinds are less likely to be discounted right now. And you mentioned, just wanted to go back to your point about earnings growth. Earnings downgrades. What do you think that the risk of earnings downgrades is more something that we're going to see in the third, fourth quarter of 2021 or a 2022 issue?
Are you asking for banks or just
Banks.
for the market at large? For banks? I'm not sure. I think for us, I think the way we look at it is more just the magnitude of growth in general. So if 3 out of every 4 large US banks that you look at is projecting to have earnings per share be down, say, 5% on average next year, how much can they really beat to move the needle in a big way for the share price?
Yeah.
You either need them to go from being 5% earnings decline next year to being up 15% in earnings growth next year, or you need those stocks to go from trading at 12 times earnings to trading at 16 times. Yeah. And either of those scenarios could play out, but I'd say it's not a very high likelihood. And they could just as easily be that they disappoint a bit on earnings or the valuations come in a bit. So we just don't see really the big opportunity for where you get outperformance and an outsized gain over the next 1 to 2 years.
No, it makes total sense. And I think that at the end of the day, a bank is a levered bet on economic growth. And I think that once you see, for example, the index of economic surprise in the United States, also the global one, is coming down because most of the good news are more than expected or discounted by the market. So all of that places as a headwind to stocks that have so much in terms of exposure to the cycle. It was chance of very, very interesting discussion. I think that it's something that we all have to monitor and make sure to tell us a couple of your other ideas in the near future. Thank you so much for your time.
Yeah, thanks very much, Daniel. I enjoyed it.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.